I want to talk about retirement adequacy, and it's been receiving increasing press, certainly over the last couple of years, and it seems to be something that the industry has been running with quite a lot in more recent times, and I think we've been swept along in that wave of retirement adequacy, and it's possibly an emotionally charged, noble pursuit that the industry's aligned itself with. But I think there are limitations to what we can actually really achieve for our members, and I think we need to be aware of that and accept that and be able to set our strategies and our frameworks around what we can actually contribute to our members' actual retirement, and be able to really just have some perspective on that. There are a lot of things that we can control. There are many things that we can't. Let's have a look at the things that we can control, and things that we can't, I don't think we should really be focusing on. Small print, quick. Adequacy. So I've got a definition there from, I think it was dictionary.com. It seems reasonably sufficient, the state or quality of being adequate or sufficient for a particular purpose. It's, I guess up until recently, it's been a bit of an ephemeral kind of concept, and recently there's been a couple of calculators that have come out. There's been the AMP Retirement Adequacy Index and the ASI Retirement Standard that seek to apply some kind of quantifiable number to what retirement adequacy means. So we have that as a bit of an outcomes, driven objective. But now we've got a number. Is it realistic to expect that superannuation is going to be the workhorse or the sole provider of that number for all our members? And notwithstanding the paternalistic role of super in our members' quest for building a retirement nest egg, we need to take a collective deep breath as an industry and acknowledge internally what we can do in the adequacy space and what we can really deliver to our members. So who's ultimately responsible? I mean, there are three key stakeholders as I see it. We've got the member, the fund and the government, and we're sort of talking in a DC environment. Ultimately, the member is responsible for his or her retirement. The fund is really a vehicle for them getting there, and the government sets the rules or the parameters around how we can actually go about doing that. And each, in an ideal world, would work together. We'd all understand what each other's role was and how that would all come together. But I think we've all got the member, the fund, the government have possibly competing objectives. And even though we understand what each other's role is, it's not necessarily all heading in the right direction. So I think ideally we can all work constructively together, but ultimately the member is responsible for their own retirement outcome. And as a fund, we have to we acknowledge that as a DC fund, but how do we contribute to that? And I think superannuation needs to be seen as really just, one of many potential contributors to a member's retirement savings. So members need to be educated by any means, but I guess by the fund as a paternalistic organisation managing its member savings, the one pot of member savings, as to what the super fund can really provide to its members, rather than, making motherhood statements and providing an expectation that members' retirement adequacy can be delivered solely from superannuation, so therefore they can step back from taking any kind of responsibility for it because the super fund and the age pension will deliver that. And I think it's incumbent upon each fund to be able to reflect that accurately and openly and transparently to its members. So just to give a bit of a realistic or a real world example of the discussion that we've been having, or I've been having, rather than just having a theoretical conversation, I just wanted to have a look at my son, which is now Kinetic Super, and provide a bit of a reality check and look at our member profile and what we're doing or not in terms of retirement adequacy. I guess with our fund, we've got contractors, temp workers. We sort of work predominantly in the recruitment industry. We originally grew out of the recruitment industry. So a lot of low-pay contract workers, temp workers, broken work histories, those who are temp accountants or work in the retail sector, and every fund has its own idiosyncratic member profile. But for us, our members stay with us for around 2 years on average, so they're not really even with us for anywhere near approaching retirement. Only 1% of our assets are in the pension phase. So it's really just it's something on the side of what we're doing in the accumulation sector of the fund. It's a very young demographic, average age 35, so a long time to retirement, so a very long time horizon. And that's just a function of the industries that we service. That's just where our fund is placed, and voluntary contributions are the exception. So most members, they join, they're active, very quickly stop making voluntary contributions, and then very quickly become inactive. So that's just the environment that we work in. And so, what do we do? How do we actually get retirement, let alone super, on the radar of our members? And that's very, very difficult. I think we all have that same issue across the industry more generally, and it's something that's very, very hard to do, because most members just don't even think about super. So retirement is, and as I said, because they're in their mid-30s, retirement's too far down the track to really even contemplate. So we have our question here. Do I read that out? I'll read that out. Is the issue of adequacy taking the focus of super funds away from other activities? No, adequacy is the most important issue facing super funds today. Yes, we need to address the provision of outcomes for members whilst they're with the fund. Or C, what's adequacy? Then we'll come back to the answers there very soon. Actually now. 100%. That's not too bad. Okay, we need to address the provision of adequacy. So I think there's quite a clear, unambiguous response there from the audience. Oh no, there we go. I spoke too soon. Yeah.
Oh, you just influenced it.
There we go. 13% said, what's adequacy? I want to ask for a show of hands. Okay, so clearly adequacy is something that's very important across the industry, something that most funds are thinking about, and I guess as I think Mike Drew may have talked about demographics yesterday. As for most funds, as the membership as we go through time, the membership gets older and gets closer to retirement, it's going to become a much more important focus. So, is it feasible to actually provide for retirement adequacy solely through superannuation? I would humbly suggest not very likely at all. So, some research that we've done back of the envelope would suggest it requires something like a 10% net return per annum, and that's year after year over a member's full working life, so 45 years, 10% per annum every year. Now, we know that's highly unlikely. It significantly exceeds historic long-term investment returns, even from high-risk assets. So, given that basis, what do we actually do? Do we say, well, that's the objective. We need to go for that. Let's just structure our investment strategy to achieve that outcome. And it's going to be highly unlikely that we're going to do that. Even an Australian shares option, which most funds have, falls short. It might have a 5% return over CPI as an objective. That still falls short of the 10% per annum, or north of 10% per annum that we need. And it also brings with it, volatility and sequencing risk. So there are a whole range of issues which work against achieving that kind of outcome. And even if I, as a CIO, went to my investment committee or board and said, look guys, we've done the research, guys or girls, and we've done the research and we believe that we need 10% per annum to achieve retirement adequacy, because you've indicated that one of the key objectives is to deliver adequacy through superannuation to our members. I would find it very difficult to believe that our board would say, yeah, let's lock that in as our default strategy first of all. And I can't imagine that APRA, as our regulator, would accept anything like that as a default strategy. So I think we've got some competing objectives here where, in terms of the regulator, in terms of our trustees' fiduciary duty, and in terms of what we can really achieve from investment returns. Should we give it a go anyway? I'm not quite sure Kinetic Super will be the first one to do that, but I look forward to any other industry funds out in the marketplace that are prepared to acknowledge what returns are required from a superannuation-only provision of retirement adequacy, and will change their default option accordingly. So I guess, for me, the summary is that adequacy through superannuation only is really a mystery yet to be solved. So what's the role of the fund? What can we do if we acknowledge, or if I acknowledge, that adequacy through superannuation only is, at this stage, not necessarily feasible with any degree of likelihood? What role does the fund have to play? What should we do? Should we just say, well, okay, that's it, we're not going to focus on it? I honestly believe that if superannuation is a savings vehicle, and members are with the fund for a finite period of time, obviously we prefer them to be with us from commencement of employment straight through to accumulate, their whole working life and into their pension phase. But if they're not, we have to seek to provide them with the best outcome that we can whilst they're with the fund. That's our fiduciary duty. And to do that in a way that manages their risk profile, manages to their expectations, but also to what we can, reasonably achieve for them, so that if they do, through the rest of their working life and into retirement, wherever they are, they've got a good base to build on that from. So our relationship with our member is during the period that they are a member of the fund with us. And I think it's important that we're seen as a vehicle that can contribute positively to a member's wealth retirement. So it's really superannuation's a savings management vehicle, not necessarily an outcome guarantee. And I think that sort of sets the framework for how we have our relationship with our members. It is a savings vehicle. And I guess it gets back to, in the old DB environment, the old DB language, that there's an asset liability mismatch between expected returns and required outcomes. So if the liability is the required outcome at retirement, the expected returns based on our modelling is X, then there's going to be a gap, and that's the asset liability mismatch. How do we manage that mismatch, and how do we actually seek to either reduce the mismatch over time, or to accept that there is a gap, and then work with our members to find other vehicles that will actually deliver on that gap, and so that they have the requisite amount of assets at retirement to match their expectations. And so the trustees have a duty to consider the default strategy in terms of achieving some kind of retirement adequacy, but to the extent that they can. And we also have to, and I guess one of the other issues is, how do you balance achieving member outcomes with fund sustainability? Obviously with APRA now seeking to ensure that all funds are sustainable from a commercial perspective, how do we balance the products that we're providing our members, ensuring that we're retaining our members and being sustainable and being able to fund the ongoing operations of the business? They're not necessarily in alignment or necessarily mutually exclusive, but that's something that we do need to consider, how we have a product range and a cost base that allows us to deliver to members, but also ensure the ongoing success of the fund. Expectations management, I think that's really the key, both for members and for trustees. If we don't think it's reasonable yet to expect adequacy to solely be provided from superannuation, then we need to express that to our members through the PDS, through ongoing face-to-face engagement on the websites these days. It needs to be transparent. We need to ensure that they understand what they can do. We all know that if we want members to get a better outcome, they may need to increase or have some voluntary contributions, work longer, have their expectations in retirement managed. There are ways to get better outcomes, but they need to understand that very early on rather than right at the end. And trustees need to be very clear about what they can realistically deliver to their membership. And so I believe that in summary, the role of the super fund in this objective should not be overstated, but it should be understood well by all parties, and so that we can actually all work together to get the best outcome for our members. Thank you.
From our perspective, the ultimate risk is not helping to build members' retirement savings. That's the only risk worth worrying about. Every other risk is absolutely secondary. And from our perspective, a lot of that has to be framed by the members that are in our fund. As Peter mentioned yesterday, the average age of our members is around about 40, so they've got 20 plus years until they reach the age where they can actually touch their money when you use it in any form. Most of our members have a reasonable income, but it's not generally that high. It's below the population average. So the age pension is going to be a critical component for most people. And if you present value that, it's likely to be the bulk of their wealth. So when we consider our asset allocation strategy, we have to consider that the bulk of people's wealth may well be in a longevity insured, government guaranteed, long-term, low-risk investment. For most of our members who are nearing retirement, the age pension may well be their only asset besides their home. And this is where I think a lot of the design issues for our default come in. Super should be a key part of income supplement for our younger members. For people who are around about the age of 40 right now, they will have been receiving 9% plus SG for most of their working life, and they should expect to have a reasonable account balance and should be looking to take an income, and hopefully the policy environment backs that up. So the question we often wonder is CPI plus 4. It's been bandied around a fair bit. A lot of people have it in their investment objectives. Some people have objectives which are slightly lower. But the real question is, what's it actually worth? I mean, it's nice to talk about it, and it's often derived from, what the sum total of expected asset class returns are, but what does it actually give members? If you have 9.25% contribution rate, CPI plus 4 over a very long term on a $50,000 salary, you'd expect to get $42,000 of income over a 25-year period in retirement. It's about an 80% replacement rate, which is above kind of the minimum OECD standard that was referred to in the last plenary yesterday. If the return is 2%, it's $33,000, significantly lower. But what's also interesting is that in order to get close to that kind of retirement income at a 2% rate of return, you'd have to double the contribution rate. Now, the reality is for most of our members, the SG is all they get, and voluntary contributions are a bit of a pipe dream for a lot of them. So for us, we don't have the luxury, which a lot of European pension plans have, of getting very, very large contributions to supplement what might be lower investment returns if we wanted to take less risk. One of the other major issues is, well, what actually delivers to this objective? If we're saying we want to try and actually get to that objective of some semblance of adequacy, where do we want to go? Well, the chart here I've pulled out is some long-term returns of equities and bonds. Now, really, I don't want to get into the detail of equities versus bonds. It's really more growth assets versus, something providing a stable income. So it could be equities, could be infrastructure, could be property, could be anything. The reality is this is just a long-term data set that we can use to illustrate. And what this shows is rolling 30-year returns above inflation. And what's interesting is that equities have actually delivered rolling 30-year returns above inflation over most periods, but bonds haven't. Apart from the most recent period, and one dating back to the period from the 1870s, through to the early 1900s. So if you're looking at the concept of risk as delivering to a long-term objective, I'd like to think that the issue of saying equities are 90% of the risk, it's unlikely to be the case if you redraw the graph based on looking at 30-year average returns. Now, most of us can't necessarily hold out 30 years, and APRA certainly isn't willing to let us get away with waiting 30 years to measure ourselves. And a lot of the debate over the last recent period has been around the new APRA guidelines, 10-year return targets. And I think this has been a really interesting debate, and I think it's sharpened the focus of our investment committee and board in the process that we go through every year of looking at our investment objectives. And 10 years is okay for a diversified portfolio, and if it's not working over 10 years, you really should have to ask some hard questions. But one thing I would say is it is near impossible to target a return. I don't think anyone could sit here and say, I can set up an investment strategy to target a specific return over a 10-year period. The reality is there are too many unknowns. So I'd like to think, and my mum would be very proud of me because she's a retired English teacher, that we should be looking at an investment objective, not a target. Something that we should strive for, and we should look at the risk around achieving that objective, but to target it is probably the wrong starting point. The other interesting point that we've had to deal with and grapple with has been around a risk objective. And again, I find the concept a little bit puzzling. My objective is to take no risk. Now, the reality is that isn't feasible. So really we should be looking to set a risk tolerance. So once again, we would prefer to talk about saying that we've got an appetite to take risk, but there's an upper limit, rather than having an objective to take that amount of risk in every single market. The reality is that there'll be certain markets where it's more attractive to take risk and certain markets where it's less attractive. And over these kind of timeframes, there is starting to be this issue of league tables, comparisons, and the risk of short-termism jumping in, which I'll talk about in relation to the shorter term. When you look at some of the similar returns that I was putting up before, but over a 10-year period, you'll see that there are substantial number of occasions where equities don't deliver. This shouldn't be surprising to anyone, but what's interesting is those periods often occur in the 10-year period after valuations were really high. Not surprising again, but the other interesting point to note here is that equities have about a 70-75% chance of beating a CPI plus 4 objective over a 10-year period. Bonds, it's 38%. And most of that 38% is in the last 10 or 15 years where we've been through low to moderate inflation and high but declining interest rates. So if you want to bank on that kind of environment continuing, then you might want to back bonds, but we would see it's pretty hard to back that one going forward. Interestingly, if you drop that hurdle to 2%, the numbers don't improve substantially. Equities move to 80, bonds move up to 50, but it's still a flip of the coin with bonds. So thinking about the issue of lowering the investment return objective doesn't necessarily help if you're looking to load a lot of bonds in the portfolio. It does certainly help flatten out the volatility, which brings me to the issue about what I've called the very short term. A lot of risk measures that people report are focused on standard deviation of annualised returns. And when most people talk about the risk of their portfolio, it refers to that particular metric. And that's right over that period, but as I've referred to before, you do need to consider the longer term risks of those asset classes. But we can't ignore the very short term for a couple of really important reasons. One which Mark spoke to about yesterday, which is that volatility represents a real and present risk for people nearing or in retirement, particularly when they have high withdrawal rates. And that's probably the most critical thing, is it's all dependent on your withdrawal strategy. But the journey does matter to members, and volatility can lead to adverse switching outcomes. And that's a real concern for us, and the next slide I'll talk to really highlights an example where we feel a number of our members have really been disadvantaged in this instance. The other issue with communicating volatility is it can be quite confusing, and one of the biggest concerns we have around this is around the standard risk measure, something which I know AIST's been quite vocal on, and how this issue gets incorporated in the product dashboard. We have some concerns around that. And the main one is that it attaches a label to a metric, and that people might misconstrue that label as being, if an option is high risk, that means it's high risk for them. The reality is that has to be considered with, where they are in their life stage, what claim they have on the age pension, and a whole number of other things, and in particular their investment time frame. But the one thing we'd say is that an undue focus on volatility significantly detracts from what the longer term return objective should be for members. And I don't think it's any more obvious than when we look at this particular chart, which plots the returns of a couple of our investment options and the outcome that a number of our members received through the GFC. So accumulating up wealth, and this is what all of us in the room are here for. If you'd done that and stayed in our balanced option, you would have had your account balance rise up above its previous GFC high to 126,000 by 2013. Had you switched in February of 2009, and I picked that date quite specifically, you would have been significantly worse off. That particular date was the date at which we had our highest amount of member switching activity into cash. It was also the date which coincided with our member statement mail-outs post the 6-month period where Lehman collapsed. So we see this as being, I guess, a major issue around volatility management, which is a strategy can work over time, but if people can't stand the volatility and can't stand being in it, then it isn't going to achieve its job. Implications for portfolios. And I think this is one thing which I'm sure a number of the trustees in the room have been grappling with. We think it's hard to find a portfolio which simultaneously meets the long-term objectives within a number of the constraints that we've been dealt. And in particular, you can't ignore market pricing where it is. Bond yields rising off historical lows. Equity valuations rising, on most measures probably above long-term averages, and amidst a weak global economic recovery. So if you're not seeing lots of earnings growth and valuations are, somewhere around average, that makes it pretty hard to be convinced to hold a lot of equities. So what that means is that the portfolio solution has to involve, I guess, a multi-pronged approach in our opinion. Better portfolio construction, other asset types, including infrastructure, property, other growth assets. So, talked yesterday about a diversified growth fund, certainly worth considering. But ultimately, every single trustee will have to make some compromise between those long-term objectives and how they manage some of these constraints. So the title of my my presentation was Rock in a Hard Place, and I didn't have access to the iCortex, but I did have access to Google Images, and there were some pretty poor Google Images of bricks, but I think you can get the idea here. The rock in this case, and this should be the foundation, is building members' retirement savings and their income must be the first priority. And simply de-risking it for members of our fund will only guarantee they have poor adequacy. So that's not an appropriate response to the problem. On the other side, we've got some shorter term targets and reporting, and a lot of those are going to be very helpful, and they enforce good discipline and proper process, but they do risk distraction. And in the current environment, we see that investment markets are going to make it harder for some of those targets to be met. A couple of examples for us are that for our lower risk diversified options and for our fixed interest options, we've actually made the decision to lower our return objectives for those because we don't think it's appropriate to maintain them at the level they were before. And we think it's important to communicate to members that they should be expecting lower returns over the long term from fixed income.